The moment the tariff order went live, executives in Manhattan understood that something had gone wrong. Trading floors flickered red before the opening bell had fully settled. Futures contracts slid. Phones lit up between New York and Toronto as analysts tried to calculate exposure. What was supposed to be a show of strength was already morphing into a stress test for the American economy. At 5:47 a.m. Eastern on Monday, February 23, 2026, President Donald Trump announced a sweeping 25% tariff on all Canadian imports. There had been no formal consultations, no phased implementation schedule, no carve-outs for critical industries. It arrived as a blunt declaration, posted online, framed as a corrective measure against what he described as unfair treatment by America's largest trading partner. The assumption inside Trump's orbit appeared simple. Canada, more dependent on U.S. market access, would have little choice but to negotiate on Washington's terms. But the move landed at a politically delicate moment in Ottawa. Mark Carney had only recently taken office, balancing party expectations with the realities of governing during global economic fragility. The White House seemed to believe that a new prime minister would seek de-escalation at almost any cost. Instead, events unfolded at a speed few anticipated. At 11:43 a.m. on Thursday, February 20th, Trump reiterated the tariff decision publicly, confirming immediate enforcement. Markets hesitated for a brief stretch as algorithms recalibrated. Currency traders reassessed North American risk. Corporate counsel teams across the Midwest began reviewing cross-border contracts. 9 minutes later, Carney appeared before cameras in Ottawa. There were no dramatic gestures, no raised voice. Drawing on years of experience at the helm of major financial institutions, including the Bank of England during Brexit turbulence, he outlined Canada's response with measured clarity. Reciprocal tariffs would be enacted without delay. Impacted sectors would receive targeted support. Consultations with European and Asian partners would accelerate. And, most strikingly, Canada would examine energy export adjustments affecting U.S. regions reliant on Canadian supply. The contrast in tone was as consequential as the policy itself. While Trump's announcement had been abrupt, Carney's response sounded calculated and premeditated. Observers later suggested that contingency plans had been prepared long before the tariff post appeared. Meanwhile, the financial consequences were immediate. Shares of major American automakers slid as investors factored in the reality that vehicle components often cross the U.S.-Canada border multiple times before assembly. Energy firms in states dependent on Canadian crude and natural gas saw declines. Agricultural distributors faced new cost projections. Within hours, more than $400 billion in market value had evaporated from major indices, with the S&P 500 dropping sharply. Corporate lobbying organizations broke ranks at unusual speed. The American Petroleum Institute, the National Association of Manufacturers, and the U.S. Chamber of Commerce each released statements cautioning against broad tariffs that could destabilize integrated supply chains. Their objections were not subtle. They framed the policy as economically counterproductive. Inside the White House, reports described a tense midday meeting. Advisors were said to be evaluating whether Canada's retaliation had been fully anticipated. Some reportedly questioned whether the administration had sufficiently modeled second-order effects, energy flows, auto production, agricultural inputs, and the legal implications under the United States-Mexico-Canada Agreement, USMCA. Others emphasized that Carney was not an inexperienced political novice, but a seasoned financial operator accustomed to managing crises. The deeper miscalculation may have been political. Canadian leaders quickly consolidated around the idea that sovereignty required a visible response. Provincial premiers coordinated with industry leaders. Calls flowed between governors in Michigan and Ontario, between Montana and Alberta. Supply chains that had taken decades to integrate suddenly became leverage points. Carney's team appears to have recognized that domestic expectations demanded firmness. For a leader elected on economic competence, appearing passive in the face of unilateral tariffs would have been politically damaging. Retaliation, executed swiftly, reframed the narrative from vulnerability to resolve. The legal dimension further complicated matters. The USMCA, negotiated and signed during Trump's earlier term, contains structured processes governing tariff adjustments and dispute resolution. Canadian officials signaled their intention to invoke those mechanisms, arguing that unilateral across-the-board tariffs violated procedural commitments. If adjudicated against Washington, the episode could raise broader questions about U.S. reliability in honoring trade agreements. Economists began outlining cascading risks. A sustained 25% tariff on Canadian imports would raise costs for American manufacturers reliant on intermediate goods. If companies absorbed the cost, profit margins would narrow. If passed on, consumer prices would climb. In energy markets, potential supply constraints in parts of the Midwest could strain utilities. In politically competitive states, rising unemployment tied to factory slowdowns could alter electoral calculations. International observers were watching closely. European Union officials assessed whether coordinated responses to future U.S. trade threats might now prove more effective. Chinese policymakers analyzed the speed and structure of Canada's countermeasures as a case study in rapid retaliation. The lesson was not lost. Economic interdependence cuts both ways. Corporate leaders who had once publicly aligned themselves with Trump adopted a quieter posture. Boardrooms prioritized contingency planning over political signaling. Firms dependent on cross-border supply chains explored alternative sourcing, even as executives expressed concern privately about unpredictability in trade policy. This tension exposed fractures within Trump's political coalition. Populist supporters applauded the rhetoric of toughness, but export-dependent industries and pro-business constituencies viewed volatility as a liability. A divided alliance complicates governance, particularly when market reactions contradict political messaging. Reports from Mar-a-Lago described a president monitoring coverage closely, frustrated by headlines juxtaposing his forceful announcements with Carney's controlled rebuttal. Polling data suggested independent voters were uneasy about economic turbulence. Congressional Republicans from trade-sensitive states voiced private reservations. The market downturn functioned as a collective verdict from investors who price risk professionally. When equity values fall sharply in response to policy announcements, it signals expectations of diminished growth or heightened uncertainty. In this case, the message was unmistakable. Escalating a trade confrontation with America's closest ally carries domestic consequences. Where does this trajectory lead? Escalation remains possible. Additional tariffs, threats to withdraw from USMCA frameworks, or expanded sectoral restrictions could deepen the standoff. Yet each incremental step raises the economic stakes further, magnifying exposure for industries on both sides of the border. What cannot be undone is the demonstration effect. The 9-minute interval between announcement and retaliation has already entered political discourse as evidence that economic threats can trigger swift, organized countermeasures. The presumption that size alone guarantees compliance has been challenged. In the months ahead, attention will turn to dispute panels, market adjustments, and the resilience of cross-border supply networks. If Canada prevails legally, the precedent could influence future U.S. trade strategy. If markets continue to penalize volatility, pressure for recalibration may intensify. For now, one reality stands out. A decision intended to project dominance instead highlighted the complexity of modern economic power. Authority on paper does not automatically translate into leverage in practice. In an interconnected global system, influence depends as much on predictability and credibility as on the ability to impose tariffs. The story is still unfolding. But in those first 9 minutes, the balance of perception shifted, and both markets and policymakers took note.